Hey, investors! Are you tired of sitting on the sidelines while the markets are running wild? Do you want to learn how to spot a bull market and make it rain? Well, buckle up, because in this video, I'm going to teach you how to master bull markets and chart your way to profit. We're talking about understanding the fundamentals, reading the charts, and managing your risk like a pro. This isn't about gambling, it's about making smart, informed decisions to grow your wealth. So get ready to take control of your financial future. Let's talk bulls. A bull market is like a runaway train and you want to be on board, not stuck on the tracks. It's all about momentum, folks. A steady climb in asset prices, whether it's stocks, bonds, or even beanie babies. But remember, bulls aren't invincible. They eventually run out of steam. That's why you need to know what to look for. First, keep an eye on the overall economic climate. Is the economy growing? Are jobs being created? Are people spending money like there's no tomorrow? These are all signs of a healthy bull market. But don't just take my word for it. Look at the charts. Technical analysis can be your secret weapon, but we'll dive into that later. Remember, a bull market is driven by optimism, by the belief that things are only going to get better. And when investors are feeling bullish, they're more likely to buy. That demand pushes prices higher, creating a self-fulfilling prophecy of sorts. But here's the thing, not all bull markets are created equal. Some are like gentle giants, slowly but surely pushing higher. Others are like raging bulls, charging ahead with reckless abandon. It's your job to figure out which one you're dealing with and adjust your strategy accordingly. Now, I know what you're thinking. Jim, this all sounds great, but how do I know when a bull market is about to turn? That's the million-dollar question, isn't it? There's no crystal ball, no foolproof indicator, but there are warning signs, red flags that tell you it might be time to take some profits off the table. Keep an eye out for things like rising interest rates, inflation, or geopolitical instability. These can all put a damper on a bull market's party. Remember, the name of the game is to buy low and sell high. Don't get greedy. It's better to walk away with a profit than to ride a bull all the way down to the slaughterhouse. So, stay informed, trust your gut, and don't be afraid to take some risks. After all, fortune favors the bold. Listen up, investors. Technical analysis is like learning the market's secret language. It's all about spotting those chart patterns and trends that tell you when to buy, sell, or hold. Forget the noise, the rumors, the so-called expert opinions. Technical analysis is about cold, hard data. It's about looking at the charts and understanding what the market is trying to tell you. Now, I know what you're thinking. Jim, I'm no mathematician. I can barely read a pie chart, let alone a candlestick chart. Don't worry, I got you covered. Technical analysis isn't rocket science. It's about recognizing patterns, and once you learn the basics, it's like riding a bike. We're talking about things like support and resistance levels, moving averages, and momentum indicators. These are your bread and butter, your tools of the trade. For example, a moving average smooths out price fluctuations, giving you a clearer picture of the trend. Is the price above the moving average? Bullish, below, bearish? It's that simple. But it's not just about individual indicators. It's about using them together, like pieces of a puzzle, to get a complete picture of the market. And that's where things get really interesting. Because when you start combining indicators, you can start to identify those high probability trading setups. And that's what it's all about, folks. Finding those trades where the odds are in your favor. Technical analysis isn't about predicting the future. It's about understanding probabilities and managing risk. It's about taking the emotion out of trading and making decisions based on data. Now, I'm not saying you should ignore fundamental analysis altogether. It's still important to understand the underlying businesses you're investing in. But technical analysis gives you that extra edge, that ability to time your entries and exits like a pro. So don't be intimidated by charts and graphs. Embrace them. Learn the language of the market, and you'll be well on your way to mastering bull markets. All right, let's talk indicators, the bread and butter of technical analysis. These are your tools, your weapons in the battle for profits. We're talking about moving averages, RSI, MACD, and the whole gang. Each indicator tells a different story, like chapters in a book, revealing the market's secrets. First up, moving averages. Think of them as trend filters, smoothing out the noise and showing you the direction the market is heading. We've got the 50-day, the 200-day, even the 10-day for you short-term traders. Is the price above the moving average? Bullish. Below, bearish. It's like a tug of war between buyers and sellers. Next, we've got the RSI, the Relative Strength Index. This bad boy tells you if a stock is overbought or oversold. Think of it like a gas gauge. Is it on E? Time to fuel up on that dip. Is it overflowing? Might be time to take some profits off the table. And then there's the MACD, the Moving Average Convergence Divergence. Sounds complicated, right? Don't worry, it's all about momentum. Is the MACD crossing above its signal line? Bullish. Crossing below? You guessed it, bearish. But here's the thing. Indicators are most powerful when used together. It's like having a team of experts analyzing the market from different angles. For example, if the price is above its 200-day moving average, the RSI is showing bullish momentum, and the MACD just had a bullish crossover. Well, that's a triple threat. A recipe for profits, my friends. But remember, no indicator is perfect. They're just tools, and like any tool, they need to be used correctly. Don't rely on just one indicator. Use multiple indicators to confirm your signals and make sure you're on the right side of the trade. And most importantly, backtest your strategies. Don't just take my word for it. Put these indicators to the test. See how they've performed in the past and make sure they fit your trading style. Listen up, investors. A trading plan is your roadmap to success, your blueprint for navigating the wild world of bull markets. Without a plan, you're just gambling, hoping for the best. And let me tell you, hope is not a strategy. First things first, define your goals. What are you trying to achieve? Are you aiming for long-term growth, or are you looking for quick profits? Your goals will determine your trading time frame and risk tolerance. Remember, a goal without a plan is just a wish. Next, determine your risk tolerance. How much are you willing to lose on any given trade? This is crucial, folks. Don't bet the farm on one hand. A good rule of thumb is to risk no more than 1% to 2% of your capital on any single trade. Now let's talk entry and exit points. This is where your technical analysis comes in handy. Identify those high probability setups, those chart patterns that scream buy or sell. But don't just jump in blindly. Wait for confirmation from your indicators. And once you're in a trade, manage your risk. Set stop-loss orders to protect your profits and limit your losses. Remember, it's okay to take a small loss. It's part of the game. But don't let small losses turn into big ones. Finally, review your trades regularly. What worked? What didn't? Learn from your mistakes and adjust your plan accordingly. The market is constantly evolving, and so should your trading strategy. Listen up, investors! Risk management is not glamorous. It's not sexy, but it's the most important aspect of trading, especially in a bull market. Because even in a bull market, you can lose your shirt if you're not careful. First things first, diversify your portfolio. Don't put all your eggs in one basket. Spread your risk across different asset classes, sectors, and geographies. That way, if one investment goes south, your entire portfolio won't go up in flames. Next, use stop-loss orders. Think of them as your insurance policy. They automatically sell your position if the price drops below a certain level, limiting your losses. Don't be afraid to use them. And here's a pro tip: don't chase losses. We've all been there. You have a losing trade and you try to make it back by doubling down. Bad idea. It's like trying to put out a fire with gasoline. Accept the loss, learn from it, and move on. Another key aspect of risk management is position sizing. Don't bet the farm on any one trade. Determine the appropriate position size based on your risk tolerance and the volatility of the market. Remember, it's better to make small profits consistently than to try to hit home runs every time. And finally, stay informed. Keep up with market news, economic data, and geopolitical events. The market is a dynamic beast, and you need to stay ahead of the curve to manage your risk effectively. Risk management is not about eliminating risk altogether. That's impossible. It's about understanding, quantifying, and managing risk so you can protect your profits and stay in the game for the long haul. There you have it, folks. You are now armed with the knowledge and tools to master bull markets and chart your way to profit. Remember, it's not about timing the market perfectly. It's about time in the market. Stay disciplined, stay informed, and never stop learning. The markets are always changing, so you need to be ready to adapt and evolve. But most importantly, have fun. Trading should be exciting, not stressful. So go out there, make some money, and remember, bulls make money, bears make money, but pigs get slaughtered.